China's economy has slowed sharply this quarter, raising concern inside Beijing and across global markets. Official data released on Monday show that the world's second-largest economy expanded by just 4.8% in the third quarter of 2025, the weakest pace recorded this year. The report from the National Bureau of Statistics blames two major factors: a steep decline in domestic consumption and rising pressure from international trade disputes. Outside the Bank of China headquarters in Beijing, the glass towers gleam beneath a clouded skyline, but the optimism that once defined the Chinese growth story has faded. Policymakers inside are now confronting slowing household spending, high youth unemployment, and investor caution that has chilled new private investment. At the Sanlitun shopping district, the country's fashionable retail hub, the streets are busy but quieter than before. Shopkeepers say foot traffic has dropped. Luxury brands are scaling back their advertising, while smaller stores report that customers are buying less and saving more. Economists note that consumer confidence remains fragile despite targeted government subsidies and discounts aimed at stimulating local demand. Across the Guangzhou clothing markets, merchants describe racks of unsold stock. Factories that once worked through the night to meet export orders now run on shorter shifts. The decline in international demand has rippled through the industrial provinces, weakening transportation, logistics, and small-scale manufacturing alike. China's official statement attributes part of the downturn to external uncertainties, diplomatic shorthand for tariffs and restrictions introduced by key trading partners. The timing is sensitive. The figures coincide with a 4-day closed-door Communist Party meeting that will define the country's next 5-year economic, political, and social roadmap. Behind those doors, President Xi Jinping and senior officials are debating how to steer China away from over-reliance on exports and heavy infrastructure toward an economy led by domestic consumption and technology. In his opening remarks to the Assembly, Xi Jinping reaffirmed Beijing's confidence, declaring, "China's fundamentals remain sound and our long-term growth will not be derailed." The message is one of reassurance, but analysts are skeptical. Many believe the structural challenges are deep: a shrinking workforce, rising debt levels, and persistent weakness in the property sector. On the production side, scenes from Hefei's NIO electric vehicle assembly lines reveal the balancing act. Robotic arms move in perfect rhythm, yet managers admit the pace has slowed. Domestic sales are down, and higher component costs are eating into margins. Government incentives have kept factories open, but demand has not fully recovered. At the Penglai wholesale markets in Shandong province, food vendors adjust prices daily as transport costs climb. Vegetable sellers say the profit margins are vanishing, while floods in southern regions have pushed some produce prices sharply higher. Economists warn that even moderate inflation could further weaken purchasing power among lower-income families. Inside Beijing's Apple Store, customers browse carefully, checking prices before committing to any purchase. Even tech enthusiasts are holding on to their phones for longer cycles. Retail analysts say the slowdown in gadget upgrades is another indicator of declining consumer optimism. Supermarkets in Shanghai tell a similar story. Aisles remain stocked, but shoppers compare prices more than ever. Imported goods now cost significantly more due to tariffs and the weaker yuan, while locally made products are stable, buoyed by state price controls and domestic supply. The government portrays this as evidence of resilience, but it also shows how intervention is masking underlying weakness. Across the Pacific, the confrontation with Washington is intensifying. Earlier this month, at a White House press event, President Donald Trump warned that if Beijing continues its unfair trade practices, we will impose 100% tariffs on Chinese goods starting November 1st. The statement shook investors and fueled fears of another trade war between the world's two largest economies. The dispute centers on China's rare earth export restrictions, materials vital to electric vehicles, wind turbines, and advanced weapons systems. Beijing says the curbs protect national resources and environmental interests. Washington calls them economic blackmail. Behind the rhetoric, negotiators from both sides are still talking, trying to organize a potential face-to-face meeting between Trump and Xi before the end of the year. The stakes are global. Higher tariffs could drive up consumer prices worldwide and slow recovery in already fragile economies. Meanwhile, China's leadership faces the urgent task of boosting domestic demand to cushion the external shock. Household incomes, however, have stagnated and unemployment among young people has remained high. A leading Shanghai economist summed up the sentiment succinctly. People are saving because they fear the future, not because they're confident in it. At Yangshan Deepwater Port in Shanghai, once one of the busiest shipping complexes on Earth, container stacks rise like silent monuments to the slowdown. Shipping volumes have dropped and port officials report fewer orders bound for Europe and North America. For a nation built on export success, the image is striking. In response, the government has rolled out several targeted measures. Small businesses are receiving limited tax relief. Electric vehicle buyers can claim fresh subsidies. Pilot programs using the digital yuan aim to stimulate consumer transactions. Yet analysts say these efforts are incremental rather than transformative. They ease the pain but do not change the model. Broader reforms, from pension expansion to healthcare access and income redistribution, would take years and enormous political will. The property sector remains one of China's heaviest burdens. After years of speculative building, developers are defaulting on debts and leaving unfinished apartment blocks scattered across multiple provinces. Home buyers, uncertain about delivery dates, are demanding refunds or refusing to pay mortgages. The government insists it will prevent systemic risks, but it has resisted the kind of large-scale bailouts that could stabilize the sector quickly. That caution, while fiscally prudent, continues to weigh on public confidence. Internationally, investors are pulling back. Foreign firms report tighter regulations and unpredictable compliance rules. Some multinational manufacturers have begun relocating portions of their supply chains to Southeast Asia. Beijing counters that these are temporary adjustments and emphasizes its commitment to open markets and global cooperation. During the Global Women's Summit in Beijing, President Xi Jinping told delegates that China's path to modernization is unique, but it contributes to global stability and shared prosperity. His words echoed through the domestic media, reinforcing the message that China remains a pillar of the international economy, even if growth has slowed. Financial analysts, however, are focused on numbers rather than rhetoric. They point to slowing factory output, weak consumer sentiment, and reduced private sector credit. Global banks, including HSBC and Morgan Stanley, now project China's full-year growth at around 4.6%, below the government's informal target of 5%. That modest difference underscores a larger reality. China's transition from hypergrowth to steady expansion is proving harder than expected. Within the Communist Party meetings, delegates are reportedly discussing plans to expand domestic tourism, reform rural land policies, and encourage families to have more children. These social policy levers aim to balance economic and demographic pressures, yet implementation will take time. Observers say the government's ability to manage expectations may determine its success as much as any fiscal intervention. At the same time, China's leadership is determined to present an image of control. State television highlights technological achievements, from new high-speed rail projects to advances in semiconductor design. The message, innovation, will offset slower traditional growth. But industry insiders admit that export restrictions on advanced chips and Western-imposed technology bans continue to constrain progress. For ordinary citizens, the consequences are tangible. Graduates entering the job market find fewer opportunities in tech and finance. Small business owners struggle with high borrowing costs, and households, still recovering from pandemic-era losses, are cautious about taking on new loans or mortgages. Economists argue that confidence, not capacity, is China's greatest missing ingredient. The nation has the factories, the savings, and the infrastructure. What it lacks is the optimism that once powered its economic miracle. Still, Beijing's leadership insists that the fundamentals are strong. They highlight robust industrial capacity, expanding green energy sectors, and continuing investments under the Belt and Road Initiative. In official messaging, the third quarter slowdown is described not as a setback, but as part of a necessary adjustment towards sustainable growth. Markets are watching closely for any announcement from the party conclave. A hint of new fiscal stimulus or central bank easing could stabilize sentiment in the months ahead. If policymakers can combine structural reform with moderate stimulus, analysts say growth could rebound modestly by early 2026. For now, the 4.8% growth figure captures both sides of China's story: resilience under strain and vulnerability under pressure. It is proof that the Chinese economy continues to expand, but at a slower, more deliberate pace than in the boom years. Whether that slowdown becomes the new normal will depend on how the leadership manages the coming trade standoff and domestic reforms still on the drawing board. In the closing scene, the Yangshan port cranes stand motionless over the water, containers stretching toward the horizon. China's vast economy is still moving, but cautiously, aware that every policy decision, every trade negotiation, and every consumer choice will shape the trajectory of the decade ahead. China's growth may be cooling, but global attention on its next move is only heating up.